Thank you for tuning in to the February edition of Market Compass, where we share our thoughts on the latest economic and market developments. This month, we're going to use a global lens to discuss how the world economy is progressing, what are the key trends that we are monitoring, and what it all means for you. Last year saw some unique challenges and economic headwinds, many of which were global in nature. High inflation around the world forced central banks to raise rates aggressively, while the war in Ukraine and renewed lockdowns in China weighed on global economic activity. Geopolitical uncertainty remains high, and the effects of the rise in borrowing costs that we have seen will continue to be felt this year. But the outlook for global growth has improved in recent months. So, what's changed? To begin with, confidence in Europe has started to recover, as an unseasonably warm winter helped avert a much-feared energy crisis. Natural gas prices shot up when Russia cut off its natural gas supply to the region, but they've now returned back to where they were before the Ukraine invasion. Related to this point, the European economy was expected to contract last quarter, but instead showed slightly positive growth. And as with the US and Canada, the European unemployment rate remains at historic lows, supporting incomes and consumer spending. The other positive development is China's reopening. After battling a COVID-19 resurgence, the country pivoted away from its zero-COVID policy. In light of the pivot, we are expecting China to experience what most of the Western world saw in 2021. The reopening should release pent-up demand, while government is supporting growth. Because of this, China is the only major country where growth is expected to accelerate from last year. Of course, risks do remain. For example, we could see an escalation in the war in Ukraine. But overall, it appears that the global economy has avoided some of the worst-case scenarios. A big piece of the investment puzzle over the past 12 months has been inflation, and central banks' response to it. Eurozone inflation appears to have peaked, but core inflation, which excludes food and energy, remains sticky and is higher than it is in the US. Because of this, the European Central Bank has more work to do in our view, and we believe it will stop hiking rates after the Federal Reserve does. As a result, we expect the difference between US and European policy rates to narrow going forward, which could be less favorable for the US dollar. Speaking of the dollar, last year it was exceptionally strong against other major currencies, rising to a 20-year high. It has begun to soften, but still remains above its two prior peaks in 2016 and 2020. The question is, what could make the dollar weaken even further this year? In our view, a Fed pause and a reacceleration in global growth by year-end could be the two catalysts. Historically, international equities tend to perform well when the dollar is weaker against other currencies, and vice versa. US investments typically outperform when the dollar is stronger. Even a modest shift lower in the dollar could be a catalyst for better international equity performance. And we've already started to see early signs of this playing out. Equity markets are not ignoring the better news coming out of Europe and China. You might be surprised to learn that international equities outperformed US equities last year, even though both were down significantly. Over the past 6 months, that outperformance was more noticeable, especially when you look at emerging markets and Chinese equities. But despite the rally, international equities still trade at a near record discount relative to US equities. That historical discount has averaged about 11%. As of mid-February, the discount is about 30%. This to us suggests that there is more room for global indices to catch up and make up some of the lost ground over the past decade. This leads us to our last point. International diversification still makes sense in our view. Leadership often rotates, and bear markets, like the one we are experiencing, tend to trigger those rotations. Technology and other growth sectors of the economy have supported US outperformance over the past 12 years. But high interest rates could favor sectors that trade at lower valuations and pay dividends. These type of companies have a higher representation in international indexes. It's nearly impossible to predict exactly when leaders might turn into laggards and vice versa. But diversifying your portfolio across asset classes and regions can help spread out risk and give you a chance to participate in whatever region is outperforming at any given time. With that, thank you for tuning in. We will continue to share our insights on the financial markets and what that means for your portfolio. So look for another video next month.